Welcome everyone. Welcome to Legit Crypto and Forex. It's actually so nice for me to be with you again. I trust that you have been finding this channel so impactful. Just a quick one. I want to show us a trading strategy and explain moving average to the simplest. Now, many traders, many traders um, have used moving average incorrectly many times. In fact, 99% of traders use moving average incorrectly, leading to their loss and blowing of account. Now, this strategy focus on specific patterns. It focus on momentum. It focus on advanced moving average strategy that will lead to consistency in your trading career. Now, I will be taking it step by step just so that you will be able to understand this. Now, I'm going to take from the simplest to the advanced method. From the simplest to the advanced. Now, we all know moving average means MA, and moving average always move in direction of the price. Moving average is a trend indicator. Now, let me show you. Now, you click on the indicator here. Click on the indicator. Click on the indicator. Click on main chart. You discover that the moving average is a trend indicator. Look at it at this particular place here. Now, moving average is a trend indicator. It's a trend indicator. Now, in this video, I will start using the 50 average 50 moving average. I'll start using the 50 moving average. Now, just follow me. Just follow me. I will start with the 50 moving average. 50 moving average. Now, um, the 50 moving average is one of the moving average I love using, and one of the strong moving average I will ever have in the Forex market. Now, look at the settings very well. I'm not in a haze. I want you to look at the settings. Now, we have period 50, shift, we have 0, and then we have method, we have exponential, apply to close, levels, we don't have levels, we don't have it is to all time frames, and our style, I'm choosing this color. Now you can decide to choose another color, but me, I prefer this color. So let's move on. You click on save. Look at it. Look at it. Blue color. You see it? Blue color. Blue color. That is a 50 moving average. Now, for you to be able to use this moving average to trade profitably, you need to wait for pullback. Don't chase breakout. You need to what? Wait for pullback before you trade using this strategy. Don't chase for pullback. Now, one of the common mistakes that traders do is chasing price breakout when price break either above or below. For example, breaking above, you see price breaking above here, or when price breaks what? Breaks below it, which here is an example. This is a breaking what? Below. That is one of the common mistakes that traders usually do, chasing price breakout either above or below the moving average, which often lead to false signal and losses. Now, the correct approach for you to trade this kind of trading strategy is for you to wait for the first pullback to the moving average after a significant breakout. Now, for example, when this breakout happens, look at this breakout happens here. There was a breakout here, but you are not encouraged to enter any trade at this particular point because of the rule of this trading strategy. Now, the breakout said when there is a pullback. Now, look at this particular place. There is a pullback in this particular place. Look at the pullback. Now, the pullbacks are actually a signal for you to enter the market. Now, you need to set your moving average very well, and then you wait for a clear breakout either above or below. Like we see here, we saw a breakout above, and we actually traded it. And then you wait um, for strong volume. Now, after every breakout, most times when price return back in the pullback direction to test the 50 moving average, there's always high momentum. Look at it, high momentum, high momentum. Now, after which you see momentum building, that is accelerating upward. When momentum is building, it means it's accelerating upward. When momentum is dying, it means that it is decelerating what downward. Now, before price moves significantly, you must be able to check this thing. Very important. We call it slope. We call it what? Slope. Slope. Now look at it. Now before I move them, look at what happened. There was what? There was a you see it. There was a pullback to the direction, to the moving average, and then here comes the direction. A massive momentum was introduced. Look at it. Massive momentum was introduced, and then look at this. Now the same happened here. Here you see this is today's trade. That here comes a pullback and then comes this direction. Now we can wait for when price will start going upward, so that we will trade in direction of the breakout, because now there is already pullback. Do you understand? Now we expect price now to move what upward, and it will continue tomorrow. It will continue the next day. You get it? Now, instead of chasing breakout, wait for the market to come back to a favorable entry point before you trade this particular market. Now, the entry point is your pullback, and at the area of the pullback, price will always gives good chart patterns. There is always good chart patterns that price will give you, so that you'll be able to identify it. Like look at it here, look at this double top. You see double top, double top, and look at what happened. Guys, look at what happened yesterday. That's yesterday. Look at what happened. Look at what happened. I just closed a trade on this. I just closed a trade on this, which I posted to my group. I just closed a trade on this. Even today I traded here for a sell. I just closed it. Now I want us to understand something. Now once there is a breakout, you wait for pullback back to the moving average 50. This is the moving average 50. After you have gotten a clear pullback, then you enter in direction of the breakout. That is it. But before um you do that, you need to understand something. Now there is what we call acceleration and deceleration. Acceleration and deceleration. Now, we need to understand that's the importance of moving average slope, acceleration and deceleration. Now, moving average tells us actually, if momentum is building or momentum is dying. Now, before price moves significantly, there must be either a steep slope, which is a sign for strong momentum, which indicates strong potential trade. And then we can also be able to see a flat slope, which signifies weak momentum, indicate choppy market. And I always advise us to avoid such kind of market. During a flat slope, stay out of the market entirely, because it will definitely lead toward to loss. Now, what is a steep slope? Now, look at this steep slope. Look at this steep slope. This steep slope. Now, this steep slope, this is a what we call steep slope going down. Is a slope going down. When you see such kind of thing, you know that there is momentum in the market. Look at steep slope. Look at steep slope. This is it. It's as simple as this. Now, if you check here, the steep slope now is forming in this direction now. Is forming in this direction. That is why I told us that we'll be going bullish by tomorrow, because of the steep slope. Now look at another steep slope. Look at this steep slope here. Look at this steep. This is what we call steep slope. Steep slope is a proof of strong momentum, and also it indicates strong potential what? Strong potential trade. Now look at the flat market that I'm talking about. This particular thing is a flat market. Now, once you see such, run away from trading. Run away from trade. Look at the flat market. Look at the flat market. This is not a slope, it's a flat market. Run away from such what? From such trade. Look at what happened here. Let me compress this so that look at this. You see this very clear. You see it's dangerous, deadly. It's called what? It's called flat slope. Is called flat slope. Now, weak momentum shows us choppy market, and also very slow. In fact, the tendency of you making profit here is zero. Stay away from such market if you love your capital. Now, let's move on. After we have understand this steep slope and how we can actually benefit from it, I want us to understand something quickly, that before every trade, check your moving average slope. After you have checked it, if the slope is steepy, pointing either upward or downward, you will know the direction. Now, if it is pointing upward, you are going for a bullish market, that's for a buy. When it's pointing downward, you are going for what? For a sell, that's short. Now, if the slope is flat, stay away from the market. Now, the benefit of this is that it increase and improve our win rate dramatically by helping us to filter out trade in weak or sideways market. When trade is weak, which means that there is deceleration, there is no much um, momentum in the market. It's weak. There is no much momentum in the market. It helps us to filter such kind of trade when there is less momentum in the market. Now, this is a very strategic and simple way in which we can use the moving average. Now, I want to take this thing more deeper. Now, this is only for those that will watch this video today to the end. I'm going to take it more deeper. Meanwhile, if this video is helpful to you, you can go ahead and subscribe to this channel. Do also like and comment on this video, and it will be a great joy that I hear from us through the comment section. Yeah. So now let's take this further. I want to take this thing further now, the moving average. Now, um, I want us to understand something. That moving average can also serve as our high and low channel. We can use this as high and low channel. What do I mean? Just like the way that we have our channels, moving like this and like this. This is the high, this is the low. We can actually use moving average for such. Now, but the problem is that the common mistake that traders usually do is treating moving average as a single or static line based on the close price, because that's what moving average give. Now, price often oscillates above and below this line before reversing. So the best way for us to trade to make profit is to use a moving average channel. Use a moving average channel. Now, based on high and low prices, the benefit of it is that it provides a margin of safety and clearer market structure. If we are going bullish, price is above the channel, looking for long opportunity near the top of the channel on what the pullback, because the pullback is a proof for us that we are actually in a safe zone in the trade. I'm going to show us this now. When we're going bearish now, the price is below the channel usually, and then we're going to look for short opportunity, that is the buy opportunity near the bottom of the channel on the pullback. Now, the channel act as, or like, let me use the word like a magnet, pulling price back when it moves too far away. And this also help us to identify fake um fake breakout, help us identify stop hunt, help us to identify traps that the market makers are making, and also filter many things. So when we do that, it help us a lot. It help us a lot, because there are many fake outs, there are many traps. Most times market makers or the dealers will go against the market and then quickly return back um to take the right position. Now, the moving average now help us to identify this. So how can we identify this fake out or stop hunt and traps? Now, never trade immediately after a breakout in the moving average. Like for example, you see, let me look at an example that implicate this. Let's see. Like for example, a quick breakout here. See the upside. Never trade it. Never trade an immediate breakout on the moving average. Never. Wait 15 minutes at least for you to be able to confirm this by a 15 minutes candlestick. Now, if price cannot stay on the new side with volume, that's after the pullback, it's likely to be actually a stop on or a trap, and it's actually a fake out. Now, the opportunity is that false fake out or breakout often lead to strongest move in the opposite direction, creating excellent trading opportunity. After every fake out, breakout, or trap, we'll see price moving. Why? Because market makers have deceived traders, so they will move quickly in the direction that they want to move. Now let's look at an example. Let's look at this example. Look at this. There's a breakout here. Now, all of these are actually what? Um, channels. They are not actually channels. You see them, they are channels. Look at it. And look at the last thing that happened quickly here. Look at the last thing that happened here. And then look at this kind of candlesticks. This massive candlestick. Look at them. Look at them. Look at them. This is just what I'm talking about. Once there is a fake out or breakout, often this lead to the strongest move in the opposite direction, creating excellent trading opportunity for traders to make profit. You get it? Yes. That's how it works. That is how it works on a daily basis. That's how, when there is a fake breakout, look at it. Look at what happened. A fake one, and then look at this kind of movement downward. A massive movement downward. That's normally what used to happen every day. Now, displaced moving average. Now, the problem is that our standard moving average lag behind what price. It is a lagging indicator. Our moving average is actually a lagging indicator. Now, reflecting what had happened rather than what is happening or what will happen in the market. That is why I always advise people to learn divergence. Learn divergence. Now, I have a video on this platform, on this YouTube channel, that explain divergence to the core, detailedly. Explain divergence. You can watch it, and it will really help improve your trading career. Now, the solution in order for us to have our moving average as a leading indicator is that displaced moving average are shifted forward in time on the chart. How? Look at it. Let me show you. You move it forward, move it forward like this. Instead of allowing it to be like this, you move it forward. So you look at what is happening clearly. Now, the benefits of you shifting the chart like this, it allows you to catch turning point earlier. It shows you where price will be if the current trend continues, effectively predicting futures such as our resistance, our supply, in fact, our demand and supply zone, our resistance and support zone levels, etc. etc. That's the most important thing that traders need, but they cannot see if it is like this. If it is like this, you cannot see it. So you need to move it so that you will see it. In fact, you can also use the 20 moving average, 20 moving average, and then you shift it forward. How? Come here to your moving average. Now change this 50. Let's change this 50 to what? 20. Change this 50 to 20, and then this shift, now you can make this shift to be 10, between 10 and 20, between 10 and 20. Now look at it. Now look at it. Look at it. If only you can understand this. I just wish we can be able to understand what I'm teaching, because it will change your trading career entirely. Now look at it. Look at how I shifted it, and look at what is happening. Look at it. I shifted it. Look at what is happening. Look at what is happening. Now, this is telling us that this market will sell. That is what it's telling us. You shift it by 10 candles or by 20 candles. Now, look at it. Now, based on your trading strategy, now it can be 15. Let's say 15. Let's see how it will be. See it. So, based on what you want, you can play around it and you get result. You can play around this and you get massive result. Now, this is one of the strategy that all these advanced traders will not tell you. They will not tell you, but this is a very strong advanced trading strategy using just the moving average. Now somebody will be like, how? Well, I'm telling you now, I'm showing you now I can even do a practical on this live trade. I can do a practical trading boom and crash. I can do practical on it, and you will see the result. That is how sure I am with this particular strategy. Now, the bounce pattern. Now, price tend to revert to its mean, that's moving average, after extended move, especially in range bounce. It tend to what? Reverse. When it reverse now, there is what we call momentum in the market. It gives momentum. You see it, price always reverse. You see it reversing here at this direction, price reversing at this direction. It helps a lot. It helps a lot. It gives what we call it shows momentum in the market. It's very good that you understand this bounce, because price always come back to bounce. Now, especially on the 50 moving average, I always advise people to understand it on the 50 moving average. Now, let me change the color of this. Now, this is, let me put this to become this color, and then I will introduce my 50 moving average will be our our blue color, our thick blue color. Now look at it. Now the moving average should not have shift. Should be 0 0. Now watch this video, don't miss any section. Watch it to the end. Now look at it. Look at it, guys. Look at it. Price coming back towards the 50 moving average. Price always come back to the 50 moving average. That's just the secret of it. Price always come back to the 50 moving average. Look at it. Price. We always come back to the 50 moving average. That is just it. Now when it comes back, so you look for reversal candlesticks or candle patterns, whether it is a pin bar, engulfing pattern, or any of them around the moving average. Around the moving average, look at this, around the moving average, and then you get what a quick entry for you to trade. Now there is also an advanced um, moving average trading strategy that is called the moving average rebound. Now, the concept is that a set of moving average, a set of moving averages, e.g., you can have 8 to 12 lines of different periods, or from 5 to 50 plotted together. Now, the use of this is that in strong trend, all lines are stacked in order, pointing in the same direction, and remain separated, and then what white space, which indicate strong momentum. I'm going to be showing you when we have weak momentum or we have choppy trend, it will be the opposite. And the benefit is that it provides a quick visual of market structure and trend strength, which give early warning about trend change, the reversal, when the fastest average start to roll over and crosses with the other moving average. Now, this helps to eliminate bad trade by keeping traders away from choppy market. Keep traders away now from choppy market. Let's do this. Now, watch me gradually. Watch me gradually. I'm going to put not much of them. I want to start with the 8 moving average. 8 moving average. I'll start with the red. I'll make it red. And then next moving average, I'll make it 9. Next one will be 10. 10. Then we have 11. Then we have 12. Then we have to, okay, let's make this to be very strong. To be black. Make it very black. This is what we're talking about. The ribbon. Now, once we see the red crossing the black, coming together, let me enlarge this so that we'll be able to know. It's actually a signal. It's actually a signal. Now, let me now introduce another moving average, which will be our 50 moving average. Okay, let's start from 48. 48. 48. 49. 49. 50. 50. You see it? 50. So you see how it is. This is what we call the ribbon, moving average ribbon. So once there is a cross here, is a sign. Is a sign. Once there is a cross, is that it came giving us a good chart pattern. Look at this particular cross. All of these are signs, they are signals. They're signal. Once they are coming together, it's actually a sign. Look at what is happening here. You discover that there is tendency that these will actually what will actually go this direction. Now let's take this as our support. Let's take it as our what? Our support. Now that is um that is one of the trading strategy that we have. Now there's something that I want us to understand quickly, which is the volume weighted moving average. The volume weighted moving average. Now, our regular moving average treat every price point equally. That's one of the challenge. Now, regardless of the trading volume, missing institutional what interest. Now, we need to have a volume weighted moving average in order for us to understand what they are doing. Now, I am going to change this because most times um we misses instead of exponential we have what linear weighted. Instead of exponential we use what linear weighted now, because institution use what we call the volume, the volume weighted moving average in order for them to trade. So just few of these I'm going to change it to the linear weight in order to fit our institutional world trader. Now, let me leave it like this. Now, look at it. You see how it is. You see the difference. See the difference. There is a gap. There is a gap. Okay, let me make all of them to be weighted. Let's make everything to be weighted so that let's make everything to be weighted. Make everything to be weighted, guys. Making everything to be weighted, 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 weighted. Now, everything is weighted. Now this is best for institutional what trading. This is best for institutional trade. That means it is best to signify and to highlight when there is what demand and supply, because institutions work with demand and supply zone. Now watch my video on demand and supply and you will understand what I mean. Watch it by on this channel and you will understand what I'm saying. Eh, no, base not now. So you can also apply multiple time frame analysis in order to help you filter your trading using moving averages. You apply multiple time frame analysis. I have a video on that. You can use the 1 hour time frame, you can use the 4 hours time frame, 4 hours time frame, or you use the 1 day time frame in order for you to have a good filter and go in direction of the market. Now you can use moving average period 10 and period 20 when you are going to higher time frame like 1 day, like um 1 week. You can use moving average like 20 and 10, period 10 and 20. It actually improve the win rate by 20 to 30% and help you to avoid going against the dormant market direction. That is how it works. Now having moving average clusters also help a lot. Moving average cluster. Now I will conclude this video by explaining moving average clusters. Moving average clusters. Now what are the clusters? Moving average 20, moving average 20. um I will add moving average 50, and then I'll add moving average 100. Now, moving average serve also as our dynamic support and resistance. Remember, serve as our dynamic support and resistance. And these are the moving averages. These are the moving averages. They don't look nice um, because of the linear weight. They don't look nice because of the linear weight. Now, let me change this. Okay, let me only use linear weight in the first one, while the other ones I use exponential. Yes, exponential. Yeah, correct. Exponential linear weight. Okay, fine. Now look at it. Look at how it looks like. Now, the concept of multiple moving average is just to now get their convergence at same price level. When there is convergence at same price level, it actually gives meaning to us. Now, the clusters act as powerful magnets for price, indicating strong support or resistance level where a big move is imminent. Now, either a bounce or a break in any of the direction is actually a proof. Why? Because price comes together. There is a cluster of them, the coming together of them. Now, hunt for clusters before market opens. You have to hunt for what? For clusters. Now, for example, you look for trades that um, have clusters. Trade that has what? Clusters. Look for trade that has what? Clusters before market opens. um Now this, like, yes, something like this is actually cluster. Something like this is actually cluster. Now it's actually a proof. Actually a proof. So now let's move on. Now this actually help identify exact area where significant market action may likely occur. The implementation is that need to hunt for cluster before market open. Now if price bounce off a cluster, trade the bounce direction. If price break through a cluster with strong volume, trade the breakout direction. Two things: the bounce and the break. Because of what? Because moving average is actually support and resistance indicator. When it break, you see it break and bounce, you trade the direction. Break and bounce, you trade. When it bounce here, you see bounce, you trade the direction. These are the two ways. Now the adaptive moving average. Now, most of our moving average, they are fixed. Now, fixed moving average give false signals when market condition would change or when they are volatile. Now, the solution is that we adjust the period based on the market volatility. We adjust the period. Let's not always use a static um moving average. For example, now if the market is not volatile, like now the market is not volatile, let's look at this particular trade. Let's look at the particular. The market is not volatile. You will not see you will not see long candlestick. When it's volatile, you see long candlestick. Now it's not volatile. We don't expect. We don't trade this with um with um period that are not big. You trade with period that are big, like 50 moving average, 100 moving average, etc., etc. You trade with that kind of moving average. But when it is volatile, you trade with 20 moving average, 8 moving average. Those ones will help to give you the direction because of volatility. It will help to give you the direction of the market. Now, this is just what I have for you. Now, I encourage us to integrate this concept to build your own robust trading strategy. Now, don't just watch this and then begin to trade it. You can back test the strategy and then make sure you are making profit consistently before you you use this strategy. And I would like you to backtest and also add um, some robustness in this trading strategy so that it will be unique to you. Like me, this is just what I used to use. It's actually unique to me and it has been a great help. Now, see you in the next video. Don't forget to subscribe to this channel and click the notification bell so I'll be notified. Thank you. Thank you for watching this video. Do like, share, comment, and subscribe to this channel for more information.